Hailstorms that hammered Sydney over the weekend have been dubbed a catastrophe by insurers. It's just the latest in a string of natural disasters as the debate on climate change risk rages. Last week, Australia's prudential regulator warned climate change could threaten the stability of the entire financial system, and it's chastised companies for a lack of action. It follows a landmark legal opinion that company directors could face heavy fines and damages if they ignore climate change-related risk. Here's Liz Hobday.
With heat waves, fires, floods, storms and blackouts, 2016 was the hottest year on record, as confirmed by global agencies including NASA. Corporate bosses are sweating too, with this from a top Sydney silk.
It's likely to be only a matter of time before we see litigation against a director who's failed to perceive, disclose or take steps in relation to a foreseeable climate-related risk.
His opinion has ricocheted around the nation's boardrooms.
I think it's been so significant because the opinion is coming from a very unexpected angle.
Noel Hutley's legal opinion was commissioned by two progressive think tanks. Its implications for business are huge. There's much at stake. Companies risk fines, massive damages payouts and the destruction of share market value. Board members who fail to consider the effects of climate change on their companies may be failing in their duties as company directors.
Directors are now taking the opinion to their executives and saying, okay, we need to think about this issue perhaps from a little bit of a different perspective than we were thinking about it before.
It also has the watchdog APRA playing catch-up, making its first public statement on climate change risk on Friday. It's told Australia's banks, insurers and pension funds that some climate change risks are financial risks, with potential implications for the whole financial system. It says,
the days of viewing climate change within a purely ethical, environmental or long-term time frame have passed.
In the US, the issue is already out of the boardrooms and into the courtrooms. The oil and gas firm ExxonMobil is facing a class action, as well as fighting charges alleging failure to disclose its climate change risk. The world's biggest coal miner, Peabody Energy, has been another target, accused of saying it didn't know what global warming would mean for its business, while keeping its internal modelling a secret. It's been compared to the big tobacco litigation in the 1990s, and with the US courts as a litmus test, Australia could soon see similar cases. And despite the march of climate change deniers in Australian politics and the media, Noel Hutley says it will be difficult to escape liability.
On the basis that he or she did not believe in the reality of climate change, or that climate change is human-induced. The court will ask whether the director should have known of the danger.
Climate change is real and is occurring, and I think all directors, regardless of whether they're in the front line in a mining company, for example, or whether they're in a company that is a bit further removed from issues around climate change, it's part of a range of risks that directors look at.
Those risks are everywhere you look. In the resources sector, assets are becoming liabilities as fossil fuels are phased out and regulation tightens. For transport and manufacturing, there's the cost of fuel. Insurers are paying out more extreme weather claims, and for the finance sector, the risks of lending to companies exposed to climate change. But are investors fully informed?
I think, along with all aspects of reporting, we can always improve, but I'm reasonably confident that an informed shareholder picking up an annual report will get sufficient information about the company's views and the company's impact on climate.
But AXI, whose members invest $1.5 trillion in retirement savings, disagrees. It says disclosure is generally not up to scratch in Australian listed companies, and that's a worry.
We often find there's a lot of work being done inside companies to plan for various climate scenarios, discussion of risk, strategy, opportunities for new investment, but often that isn't coming out into the public domain.
AXI has found that since 2009, sustainability reporting by Australia's top 200 companies has improved, with many providing detailed information for investors, but some are still not doing enough. And almost 10% of Australia's top companies still do no sustainability reporting at all. In Australia, a Senate committee examining carbon risk disclosure is due to report by the end of next month. With well over half of the Australian share market's value made up of resources companies and the finance firms that lend to them and invest in them, the costs of ignoring or miscalculating climate change exposure could rebound throughout the economy.